Good day, everyone. The webcast will begin shortly. We'll just give it a minute or two to allow people to dial in. We'll be right back in a minute or so. Thank you. Okay, good day. Welcome, everyone. We'd like to thank you for coming to the webinar. Myself, Carl Larry, my colleague, Captain Amrit Singh, we will start our presentation here. But before we begin, I want to give you a few housekeeping notes. First, the webcast is recorded, and we'll email the recording and the slide deck to all registrants and attendees. Also, you can use the widgets on your console to interact with us. For instance, you can submit questions anytime by hitting the purple Q&A box. We'll answer questions at the end of the presentation, but feel free to submit a question anytime. And for technical help, click the yellow question mark button. There are other resources and helpful tips on those console buttons as well. Now, we'll get started here. Just want to give you a few quick notes about Refinitiv. You may already know us. We were formerly the financial and risk business at Thomson Reuters. Refinitiv is one of the largest providers of financial markets, data, and infrastructure. To learn more about us, please go to refinitiv.com. And with that, I would like to welcome everybody to the presentation today. Supply chain and COVID-19. Myself, Carl Larry, Performance Director on the corporate side here. I've been with Refinitiv for a few years now. My career has mainly been in banking, research, and consulting. A lot on the energy side, oil and gas, specifically oil. Right now, I work more on the supply chain and corporate side, covering strategy, treasury, and market assessments. So we want to kick this off, or I want to kick this off here today with a poll question. Make it nice and easy. We're going to start it off here. In a recent study by the ISM, what percentage of the companies surveyed reported some kind of supply chain disruption? If you want to click on your answer, please do so. We'll give it a minute here for everybody to get in and to just jump right in it. I wanted to start it off with a nice poll question here, kind of get everybody's, get up thinking, kind of understanding what's going on and how it's going on, and how they think it's affecting them. I can't tell you how happy I am and how excited and almost nervous to present to so many great people in the supply chain industry today. There was a lot of registered people, a lot of people online right now. It's really, really great to see that kind of participation. So we're going to get this moving here. Okay, we're going to jump here to the answers and see what everybody thinks. And we have 35%, 65%, 95%, and 75%. Slightly leaning towards the 65%. Now, I did this on purpose. I gave these numbers in this order on purpose, and I'll explain to you as I kind of go through my slides here. The reason is because as much as this pandemic has affected all of us, and is affecting us now, and will affect us in the months, maybe even a year to come, there's only so much that we know and only so much we can do. So when I kind of put up this poll, I wanted to make sure I gave it a little bit of a flair. And what I did was I put it in this order. The right answer, actually, is 75%. But the way I put it in the order, I'm a big fan and work with many people on behavioral economics and behavioral market studies. And I put that odd one out. The 75% I put out as the outlier because not many people are going to pick that thinking it is the outlier. But it wasn't the outlier. It was the right answer. So I kind of played this poll for you just to kind of give you an idea, because as we go into my presentation, I think I want to really start with how and why everything that's going on needs to be taken into consideration when it comes to supply chain and economics and what we're looking at here going forward. So if you notice that first picture to the left corner, that's a roulette wheel. So to start off this presentation, I want to kind of give you a little bit of background about what I do and what I think about. I was in Las Vegas one year, and I was walking by the roulette table. So I figured, hey, best payouts in the house. I'm going to put a few chips down on this number, a few chips down on that number, a few chips down on that number. Well, as gambling goes, I got nothing that first time. I figured I'm going to stick around. I'm here on vacation. I want to have a good time. I played the second time. Nothing hit. And so I picked up my chips. I'm not a gambler. I kind of done this for most of my career in oil and gas. I don't really need to sit at a table and gamble. As I picked up my chips and I started to walk away, the gentleman at the roulette table, the person who's spinning the wheel, he looked over at me and said, "Sir, where are you going?" I said, "I'm leaving now. I'm not winning here." He said to me, "Your numbers are coming up next." And for that split second, I thought to myself, does he know something that I don't know? Has he figured out that the numbers that just preceded the last two rolls means that out of my next three numbers, one of my three numbers will come up next? Does he have an algorithm in his head? Does he have a pattern? Is he looking at something that I didn't see or I didn't know, that he's been working here for so many years? He gets it. Obviously, I'm overthinking this. But that in itself is the point. He didn't know. It's a game of chance. It's a game of random numbers popping up, random things that were going to happen. But his job was to convince me that I was missing opportunity because he knew better. And like I said, I'm an overthinker. For that one moment, I thought maybe he knew. And that is kind of where we're at today. We hear so many forecasts. We hear so many ideas, so many people thinking they know what's going to happen here and how it's going to happen. And that brings me to that second picture there. One of my favorite movies, one of my favorite playwrights by David Mamet, House of Games. In this movie, it's all about con men and con jobs. And a really, really interesting point that they made in there, one of the main characters said, he said to another character, "Do you know what it is? Do you know why it's called a confidence game? Why? Because you give me your confidence? No. Because I give you mine." And that's where we're at today. In this unprecedented time, there's that definition there, unprecedented. This has never happened before. So for everybody that gets on a call, everybody gets on a presentation, everybody turns on the news or flips a newspaper page, we don't know what is going to happen. We don't know how this is going to work out next month or next week or tomorrow or a year from now. But you want to know more. We all want to know more. We want some kind of definition so we can figure out, and especially in supply chain, this is part of what you do and part of the way it works. We need to understand what's going to happen so we can plan accordingly. Now, the issue with that is that, we are fed information all the time. Misdirection, I like to call it. Sort of that whole thing about magic. It's misdirection. And to highlight this, just the other day, we had these two headlines come out on coronavirus. U.S. has most deaths in the world. U.S. now has more deaths than any other country, but the worst of any epidemic not being far off. And that surprised me because I thought about this and I said, how can the U.S. be higher or surpass Italy's death rate and be so just, astronomical? So I took it to the numbers. The facts are, Italy has a population of 60 million, a GDP of almost $2 trillion, but a per capita of almost $32,000. Now the U.S., by comparison, is 331 million people, nearly $20 million in GDP, or $2 trillion, and a GDP capital of almost 61,000. We're not comparing apples to apples here. The death rate in Italy is definitely more substantial than the death rate in the U.S., but the media, the numbers, everything that they put up in front of us wanted us to think how bad it was here. And it's bad. It's just not that bad. And so shifting our sympathies and empathies to us really isn't the right thing to do. We really need to know the facts. We really need to know the numbers. And especially in supply chain, what's more important to me than anything is understand what this means going forward. But I need to know the data. I need to know the numbers, the suppositions, the ideas, these conjectures are not going to help anyone economically going forward. So looking at those numbers, it's just shocking to think that they really want to grab the headlines. They really want us to see that this is so bad. Now, when we talk about this, we want to make sure we understand how this works. The COVID-19, there's definitely disruptions here, right? We've seen so many things change. And how is it spread? Through high population centers and cities and areas, manufacturing centers, which are high population centers, which obviously is affected the supply chain, without a doubt. Distribution centers, distribution routes, and people. We are all now in a mode of operation, not just work-wise, but social-wise, where everything's changed. And it's really, really hard to deal with and hard to figure out how and why how we can go forward and what we need to do next. But we're going to have to, and we're going to have to figure this out. So what I'd like to show is here's the effect. And we're seeing people being securing people, quarantines. Obviously, manufacturing centers, distribution centers are all becoming that. And we're looking at disruption of operations, like I mentioned. We're showing economic impacts. Now, everything I'm showing you here, I would guarantee that 99% of these people on this call, on this presentation, are saying, okay, Carl, I understand this. I see it. I know this. I understand what's going on. This makes sense. But the issues that everybody's talking about, the worst of it all, but we have to figure out how we see this cause, and not the supposition, not the forecast, not the idea of what could happen or how it's going to happen. I know that it's bad. What we want to look at is the effect of how we can figure out what to do next. So when we start talking about, we start seeing news and talk of how we're going to ease back into our economy. Well, we start thinking about how those people who are coming back in the economy are going to be let back in the economy. Number one, we're going to start screening everybody. It's going to happen. You're not going to have a manufacturing center or distribution center full of employees that may be at risk or could be the risk. So that's going to have to come into a cost. Then there's a reorganization of operations. Now, we're going to see a lot more automation. Why? Because when you take the risk of the person there or the person who could be the risk out of the equation, automation makes sense. Now, when we start thinking about automation, we're going to move into another process I think is going to be very important going forward. And I'm calling it AIA. I've not read this before, but if there's a report out there already that's already coined this term, I apologize, but I thought this through. What's going to happen is that we're going to have to start consuming more data and more information and backing up the facts. So no stories of how bad things are, how America's terrible. Show me the numbers. When I get the numbers, when I get the information, what is the price of the commodity? What is the price of my transportation? What is my cost of labor? What is my cost of my cash reserves? I'm going to have to analyze all those numbers. Once I get those numbers, I'm going to have to interpret what those numbers mean to me and my company going forward. And this may be a little bit different than what you do now. It may seem similar, but it will be very different because we're not forecasting here. We're planning along these numbers. And then when I understand how those numbers work, how they work in the fact sets that I have, and I've interpreted the data to filter out the static and take what I know is right going forward, I will have to apply that to my process. So along your supply chain, you're going to have to redo everything. The supply chain will look totally different. Why? Not because of where it's going, where it came from, or how it gets there, but it's going to have everything included into it. And then we're going to start looking at employees similar to the way we saw them in 2008. Again, I'm not making a forecast here. We're going back with the same logic that we saw in the last economic downturn. Do I want to hire people back? Absolutely do. Sure I do. But who do I want to hire back and why? We want to hire people back in the supply chain, into the corporate America. We want to hire these people back in whether it's financial or corporate. I've seen this in 2008, 2009. Again, I've been banking. It was more financial than it was corporate, but what you wanted to bring back into your workforce was someone who's multifunctional. How many things can this person accomplish that if I would, normal times or prior times to all this, I had 2 or 3 people working on? Can this person be multifunctional? Can they do more than one job? If they can handle engineering and they can handle processing, if they can handle treasury and they can handle risk, if they can handle operations and handle customer service, I need them to be multifunctional because I need my first dollars of any kind of corporation, of any kind of supply chain, of any kind of worker to be profitable and efficient. Major things going forward here we want to see. And then economic impacts. Market recovery will happen. Not a forecast, not a guess, not an idea that will happen, but it'll be a redistributed recovery, meaning that some areas will move faster than others, some will make more, some will make less, people will survive, people will not survive, in terms of business. We're going to see remote business operations. And this comes back to a whole redistribution of how the recovery is going to happen. If I can operate now at a minimal pace or minimal part of what I've done before, with people not occupying office space or paying for that office space, I will have to reconsider those options, especially if I'm not leased or I can find ways out of that lease or reduce the cost of that lease. I'd rather have more employees than a bigger office. And then we're going to see higher wages. We will see higher wages because it goes back to that multifunctional person. I want somebody who can do several different jobs that I can pay slightly higher than a person I could do for one job. We'll see skilled labor come back in high demand. It was always in high demand, but it was more flattened out. Now we're going to we want to see people who are skilled and can do more than one part of that skill. And then we'll see spending shifts. Way people spend money, not just from the producer side, but from the consumer side, we're going to see a lot of differences there. Now, when we talk about China and we talk about supply chain, and this is kind of something that we're focusing on and everybody's focused on, the issues with the supply chain, it's not so much that the manufacturing or that the production is coming from China or is part of China through that whole chain. If I were looking at pharmaceuticals, I know that somewhere in between, A to Z, it's going to come through China, whether it's the parts of the pieces of an auto or the actual manufacturing of an auto, it's going to come through China. And it's not as easy to supplant that or change that or shift that. One of the things we've had going forward that we've had luck with is that we've had tariffs, which has kind of pulled back some of the supply chain demand we've had from China over the years. So that's kind of pulled back a little bit. But the biggest issue with China, and I wanted to highlight it here, is you look at the US, our population, our GDP, our per capita. Now I want to highlight that. You look at the population in China on the right, 1.4 billion people. That's an amazing number of people. But if you look at the GDP per person, you're expecting a GDP from each person around $10,000. It's not America. It's far from it. But because of that low number, they have low cost labor, and that labor translates into everything from a person who's actually physically on a factory line to a person who's doing engineering work. I think the word labor is always just generalized. I think when most people hear labor, they think of that factory person on a line, going through the motions of putting tires on a car. Labor is everything from that to a skilled worker to a person who is working on a spreadsheet. Labor includes everything. When we look at the Bureau of Labor Statistics, we don't filter out, unless you're really just getting into the granular numbers of the unemployment numbers of who does what. We think of it as an encompassing number. So when I say labor, when we talk about inexpensive labor and saving labor costs there, we're across the board. Most of what China does upon supply chain, it's not just pharmaceuticals, it's mainly technology. As a producer, they create a lot of technology, a lot of parts that are very technical. Now whether that's technical in the sense of a computer or technical in the sense of a car part that is part of an electronics pattern or electronics board, it's very, very, it goes across the board. But as consumers, you were looking at China as a big part of the supply chain for people who are buying raw materials, whether it's any kind of commodity from metals to grains to energy. So we really have to think of them as not just the people who supply them, but also the people that are buying them. So, across the board, we're seeing them affecting all of the supply chain, but it's that per capita that's making a difference. That is almost impossible to replace, spared for a few places in the world. So I think we really have to focus on that there is not going to be a stopping, I'm not going to deal with China anymore, but there will be a redistribution, a rethinking of where can I redistribute my supply chain? Where can I move it around and get back to where I need to be, but also make money? Because if I'm paying more people at that part of my supply chain, I'm going to have to charge more on this side of the supply chain. So there's really a balance there, which we're seeing now. We are seeing a lot of consumers consuming differently, purchasing differently here in this quarantine. So when we talk about this, I wanted to talk. We have a really, really great program or application on our service here called the Belt and Road Initiative, and you can really get a lot of great information about everything that goes through China. And I want to just kind of highlight a few of these notes that I took while I was working on this for the supply chain. Pharmaceuticals. It's amazing to see how much of these pharmaceuticals come through China, and through is the right word. Some do come from China. A lot come from India, but what comes from India starts in China. Now, we are also seeing some slowdowns in ports. Obviously, we're seeing issues at that side of it. So kind of talking a little bit around the port side, I know my colleague will be talking more around the logistics, but something just came to light yesterday talking about manufacturing and plants, about production. This points to the ports, but we've seen meat processing plants now concerned because employees are having issues with COVID-19. Now, that's just the tip of the iceberg. I mean, we are hoping that we've flattened out the curve, but we're going to start moving on. But there will be isolated areas and isolated incidents where it's a meat processing plant, or it's a shipping port, or it's a warehouse, that we're going to have to be prepared for supply shocks, not just through China, but domestically and closer to home, because it just takes that one piece that changes everything. So I guess what I'm trying to say here is that when we look through this and we see all this about China and all these issues here, all these points that we're trying to make, again, we want to look at all the facts. We know what and how comes out of China, but we also need to know what comes out of Latin America, what's coming out of Europe, what's going to Europe, what's moving to Africa, what's moving out of Africa. Am I prepared, or can I get more information, more data to understand how at the snap of a fingers I can start shifting? You can't change everything right away, but you can start shifting. And that's where we're going to have to do things and watch things. Information here. So this chart here to the left, kind of interesting, because we really talk a lot about economics, or I like to talk about economics and see how this impacts. And you can see that, unemployment and jobless claims, and here we're looking at implied demand from energy. The blue line is implied demand from energy. The orange line is unemployment and jobless claims. So just earlier today, somebody was asking me today about, do I think that this supply cut's enough? For the oil, for OPEC Plus in U.S. and Russia and Latin America, and I look at something like this and I say, it's not about the supply. You can cut the supply down by 20 million barrels or 30. It's going to be irrelevant, because what we need is demand. If demand stays low for a extended period of time, you can cut all the supplies, and all you're going to do is increase prices. If you increase prices ahead of demand, well, then demand's never going to recover, because people can't afford it because they don't have jobs. So, we're putting the horse in front of the carrot here. So when you see this, I wanted to show this really, really shocking, chart that shows that as soon as those jobless claims came up, is as soon as that oil demand went down. And this is something that so many people are trying to forecast. You can't. Will this snap back just as quickly as it snapped here? It's going to be relative. It's going to be about if we can make it happen as quickly as it did happen, and that's usually not going to happen. But we have an idea on why it's happening. For not sounding too redundant there. Now, I want to show this because the chart on the left, I call it efficiency at a price, and you can see the blue line is actually crude oil production in the U.S., and the orange line is U.S. rig count. Now, I know not many people here are interested in oil and gas, but for what I've done in my career, oil and gas and consulting and economics, and here at Refinitiv, now in corporate space, this should be in every textbook, every class that wanted to teach people about efficiency. The reason is that if you see the average price on top there, average price over the last 5 years is about $53, which break even for most, let's say, frackers is around $30. But what happened was we saw drilling go down, people putting up rigs, whether they were onshore or offshore, that number declined. And you could see how quickly that number declined and how much it declined. And yet production of oil in the U.S. kept climbing. Right there in 2015, I wouldn't even 2015, I go to 2016, you can see where that big drop is. We started becoming more efficient. We started figuring out ways, not how to get more oil, but how to get it better. We started figuring out ways to spend more money on technology, on software, on equipment that was more efficient to pull oil out. But the biggest change, and I worked in consulting over years, so I can tell you this, the biggest change in the oil and gas industry was the embracing of big data. The more information they had, the more that they understood, and the better they were increasing production. So this is what happens. You do have to spend, and this is where it gets tricky going forward. You'll have to spend to make money. And capital expenditures, obviously, everybody's cutting back. But if there's a little bit of ease in the margins, and you can do this, this is how you can do this. How you can start producing more by using less. Now, over here in the left-hand chart, you can see there's inflation, GDP, and I want to say everything's relative here because you can see GDP was going up, unemployment went down, and we could see everything moving. But the point is that as GDP went up, inflation stayed pretty flat. And I think that's something that's interesting here is that you really, really, really want to just kind of take into consideration that as things move, we have to realize that they're going to keep moving. And whether it's, we're cynical or skeptical about it, things will start making, things still make a difference. Now here, just action, reaction. I wanted to kind of go through this. We have prior disruptions here, but you can see that so many things changed during those years. In 2002, when SARS started, China was just above 4% of the world GDP. And within, 18 years, the next, 18 years, China's jumped up to 16%. And then the unemployment rate here, we could see that, it was record lows. And you can see here after the Japan quake, increase in inventories, we changed the way that manufacturers kind of pull things through. My point here on this slide is that what we don't know is what's going to happen next. What we do know, and we could see this historically, things will change massively. We will see a major move in the way the economy goes going forward. This is unprecedented, historical, but what we do know from these moments, from these things in time, things change, very, very drastically. So, real quickly, I want to sum up here. I want to leave some time here for obviously for my colleague, but I just want to go over a few things here. What we talked about. We're going to start looking at strategic planning more so than strategic forecasting. I think that's going to be important here. We want to start looking at short term than we do long term. Long term may be a year. Short term maybe be 3 months. But we're going to have to start changing the way we do that. Bigger picture, macroeconomics are going to matter here. Before we would look at the risk, logistics, and commodities, but now we're going to start thinking about everything around that. And I think that's where it's important. We're going to start managing money more importantly. We've seen in every downturn that the American economy has gone through, or the global economy has gone through, every time there has been one, it's always about cash at hand, cash on reserve. Your cost of value, what will you want to spend for what you want to get back? And the last one, AIA, I mentioned before, analyze, interpret, and apply. We really want to focus on this, and it's all going to be about information and data and facts. That's the important part. So with that, I'm going to hand it over here to my colleague, Captain Singh, and over to his presentation.
Thank you, Carl. That was excellent. And hello, everybody. I'm part of the Definitive Shipping team, and what we've been trying to do over the past over 6 years is we've been trying to simplify shipping. And with that, we are looking at bringing almost near real-time data that people can look upon and make decisions upon. And before I start, I want to sort of pay tribute to the frontline staff, primarily the medical staff who are working round the clock and, helping people across the globe. And also I would like to highlight, obviously my background is ex-seafaring, but I want to highlight that, what you see on the chart is the map of the globe where ships are moving across the globe as we speak. And, there are seafarers who are, making sure that the flow of food, energy, essential goods, and medicines is being delivered to, ports across the globe. And these are the same people who have their families affected by the pandemic as well. But, they're doing a major job despite the difficulties that they're facing in terms of quarantines, etc., at various ports as well. So what we are going to talk about today is, a little bit of, how the ocean shipping, which carries almost 90% of the global trade, is looking in the current circumstances and what are the challenges. So we will talk about, the ton-mile demand, the supply chain congestion, the freight rates across, dry bulk, tanker, and containers. We'll look at how the Baltic indices, are performed over the past quarter, and compare a little bit with the coronavirus versus the SARS situation. We look a little bit at the GDP evolution of and the shipping's role as in the commodity supply chain. We'll look at shipping has had a plethora of new regulations coming in, like ballast water management and the IMO 2020, which is the sulfur cap. So we look at that. And, shipping going forward has also a huge decarbonization plan. And then finally, we'll, just sum it up and look at the state of play and challenges. So looking at the ton-mile demand, for me, it's a very good indicator to see, how a particular sector of shipping is doing. And ton-mile demand is simply a ton of cargo carried a distance of so many miles. So what you see on the left-hand side is on the dry bulk side, and I've put in the left-hand side is the Capesize, which is the largest dry bulk vessel carrier. And, if I look at, the ton-mile demand for 2019, there was a drop of about 4.5%. But what you see on the dotted green line is for the first quarter of this year, and that's a drop of 12%, almost 12%. And this drop signals the supply chain disruption. And, this sort of came about because of, the Brazilian area had a lot of rainfall, and Vale couldn't send out the iron ore shipments, so there was disruption caused both in inland transport and on the port infrastructure. And then it got followed by the COVID-19 situation, whereby China, which is a key importer of iron ore, had ports into quarantine. And that shows, that this indicator very quickly brings to mind as the impact that is happening on the supply chain. On the right-hand side, we have a very large crude carrier ton-mile demand, and this paints a completely different picture. So what we saw in 2019 was a marginal drop of 2.5% on the global ton-mile demand for the year, but that was the impact because of sanctions on Iran and Venezuela, and the trade war going on between China and the US. And what we see this year is the dotted green line, and that sort of is marginally down, but it held up. And it held up because the OPEC Plus unraveled, and there was a price war which started between Saudi Arabia and Russia, and that led to a huge glut of supply of oil coming into the market, even though the demand had dropped because of the coronavirus, and that led to people looking at filling land storages and the floating storages at sea. So, what is remarkable is that there are completely two different pictures. One side, we have a situation whereby we see the demand dropping, but at the same time, because of the OPEC plus unraveling, we see so much of supply. Following on, what we see on the left-hand side chart is China dry bulk ports as they were last year, compared to the blue line, which reflects how they were in this quarter. And what we can see is that there was huge congestion in the supply chain because of the coronavirus quarantine measures. And both the dry bulk, if we see in this quarter, we had a peak whereby, on the dry bulk side, the congestion was almost near double. And if we look at the right-hand side at all the Chinese containership ports, we see a huge jump in the congestion. And this is because, there are ships which are waiting for quarantine measures. Ports are not able to move containers across. So this data very quickly reflects as to how the supply chain is getting disrupted as well. Here, what is interesting is that, as the pandemic started shifting across and the epicenter started shifting from China towards further in Asia and then towards Europe and then on the US, there has been volatility in the container congestion areas. And the chart on the left-hand side, on the blue line on the top, shows Singapore. And if you see the volatility of congestion in the Singapore area, whereby, fluctuated quite a bit because Singapore is a key transshipment port in Southeast Asia. And one could see that because the impact which is happening elsewhere in the region, be it China, be it South Korea, that impact was being translated into Singapore as well. Now, as the pandemic moved into Europe, what we have here is Netherlands, Germany, Spain. We can see on the right-hand side of the first chart that we can see congestion gradually increasing when the quarantine measures are in place. The ships have to wait longer. Any cargo that is being discharged, there is difficulty in transporting across because of the distancing measures, etc., that the truckers have to follow. So it just goes to show that how the sort of ripple effect is being created as the pandemic keeps moving. And the chart on the right-hand side also reflects, and this is both for US and Brazil, and this container congestion is also slightly on the upward up, but as and when things deteriorate, we can see this congestion will slowly creep up. Looking at the container traffic on the US West Coast in the first quarter of this year, we see a drop of almost 16% traffic for Los Angeles, which is plotted on the left-hand side. And on the right-hand side is almost a 9% drop in container traffic on, when you compare quarter on quarter. And this is because businesses responded, by canceling their orders. And most of the, bigger businesses like, the big retailers or the enterprises, they were canceling their orders. But at the same time, what we've noticed is that, there are small and medium business enterprises who have a smaller inventory. They still sort of went for the shipments. So it is, as in, things shift, this sort of shows very quickly that how, the container traffic is impacted by the event somewhere, and then it gets translated into the near ports where, the traffic, inbound loaded traffic is coming in. So it's not just the impact in China, it's the impact which is translated, elsewhere across the globe as well. Now, before we go on here, I wanted to bring a poll question up. And Hello. Just to make it interesting, I wanted to bring this poll question up. All right. We can take care of the poll a little over here. So I just wanted to give you a little bit time. As you know, that Baltic Dry Index is one which is very widely followed. When do people expect the recovery in the Baltic Dry Index? And there are 4 options there. I'll give a minute to see what people's thoughts are. All right, we'll give a few more seconds. And Baltic Dry Index is interesting because, it's very widely followed. All right. Wow. So that's very interesting. A large number of people are expecting the recovery into the first quarter of next year, and almost similar numbers for Q4 2020 and Q2 2021. Yeah, so that's pretty remarkable. And Q3, nobody's expecting that things are going to improve. That's remarkable. All right. So moving on, what we look at is here in terms of how the Baltic Dry Indices have responded in the coronavirus situation versus the SARS, which happened in 2002 and 2003. Now, sorry for this chart being a little bit busy, but what we see here is in the long purple line and the long blue line and the long yellow line is how, when the SARS situation happened, the Baltic Dry Index, the Baltic Dirty Tanker Index, and the Baltic Clean Tanker Index all sort of, gradually increased and then tapered off towards the seasonal effect. And the gray line shows the SARS escalation. Now, when you look at the dark red line, which sort of starts a little bit, in sort of end of December 2019, that's where the COVID escalation started. And what is different this time is that if we look at the orange line, which is the Baltic Dirty Tanker Index for this year, if we look at the teal line, which is the Baltic Clean Tanker Index, and the green line, which is the Baltic Dirty Tanker Index, we see that the Baltic Tanker Index had the steepest fall, and this fall was almost about 80%. And the Dirty Tanker Index held up well. And, the SARS, if we look at the right-hand side, there was a SARS stabilization period, and then there was a SARS de-escalation period. So what is interesting here is that in 2002 and 2003, the, rates responded pretty well, and they still kept growing. But this time around, except the Baltic Dirty Tanker Index, and we'll discuss in a few minutes as we're going forward, the Clean Tanker Index and the Baltic Dirty Tanker Index, decreased quite sharply. Now, looking forward, the chart on the left-hand side shows the evolution of the world GDP share. And the green line is for the US. The red line, which is, a very sharp growth, is for China. So as sort of Larry was mentioning earlier in his presentation, that if we see China has more than doubled its GDP share. And the chart on the right-hand side shows the world oil consumption share. And when we look at the green line, that's for, the percentage oil consumption of the United States versus the red line, which is the percentage consumption for China. It's more than doubled. So what both these charts show is that, we look at China as just a producer at times. China is just not a producer. China became a consumer as well. So what was different this time is that because of being both a producer and a consumer, the Baltic Indices or the shipping industry had to take this, decrease on the rates because there was a decrease in demand. Now, looking at the chart on the left-hand side, what we see is that China is leading in both dry bulk and crude oil imports. So, be it iron ore, be it coal, be it crude oil, China is a key importer. And to service, this, it's the global fleet of ships. We have on the right-hand side, as you can see, bulk carriers constitute almost 43% of the fleet, while the next is the tankers, and then comes the container ship. So the maritime transport, with all the global fleet of more than 65,000 vessels, is helping to run the world trade, which is almost close to 90%. So the impact that takes place when one part or one area, which is a heavy importer, it sends shocks through the system across the supply chain. And that's what we saw because of this pandemic. Now, looking at the global fleet, here is a chart of the fleet growth. And, the gray chart represents the growth of the oil tanker fleet going forward. So this year, we are expecting 2.5% growth, but given the current events, we think this growth could be slightly lower. In terms of the dry bulk carriers, we expect a growth of around the range of 3%, which is shown in the blue line for this year. And on the container side, we see a slightly higher growth. But given the current situation, in terms of delays and most of this new building construction happens in China, we expect the fleet annual growth to be slightly lower than what we can see here. Now, in terms of shipping, as I mentioned earlier, shipping has a plethora of regulations that have come into play. In 2017 was the ballast water management system. And why it is key is that from 2019, all existing ships have to have a ballast water management system on board. And this needs to be completed by 2024. This entails an investment of roughly $60 to $80 billion on the shipping fleet, which is currently existing. On top of that, at the start of this year, on 1st January 2020, we had the global sulfur cap come in, whereby the ships were mandated to use a fuel of 0.5% sulfur. And this entailed that the ships have choice of either, using low sulfur fuel oil or install exhaust gas cleaning devices, which are also called scrubbers, or look for alternate fuel, which could be LNG, ammonia, methanol. There are, all sorts of different alternatives which people are looking at. And this again comes at a cost. So besides what is currently happening because of the pandemic, these were the cost pressures which were coming onto shipping as it is. Now, going forward, what shipping is also trying to do is, the emission of greenhouse gases from shipping is in the range of 2 to 3%. So the International Maritime Organization has mandated that by 2023, there has to be finalization of some short-term measures to reduce carbon dioxide. By 2030, the decarbonization should achieve 40% reduction as compared to the 2008 levels. And by 2050, the aim is to achieve a 50% reduction in the total greenhouse gas emissions. And beyond 2050, the goal is to phase out the greenhouse gas completely. Now, all this requires new technologies, requires new fuels to be tested, and this is, again, a huge cost. And this cost gets translated into the commodity supply chain because ship owners looking forward will have to address these because ships have a life of, roughly about 20 to 25 years. And this will have to be kept in mind so that you don't come at a situation whereby 10 years down the line, the asset that you have is not complying with the existing regulations then. Now, looking at all this, here is a chart of, the world trade volume of goods and services. And what we see on the right-hand side is a sharp drop. And this has come about because of, the ongoing trade war. This has come about because of the sanctions, also the unraveling of the OPEC Plus, but the key thing has been because of the coronavirus pandemic. So looking ahead, shipping is very demand-driven. And because it's demand-driven, what we see is there are severe headwinds for shipping ahead, and shipping will have to cope with it. Now, in terms of, the state of play and challenges for shipping, just quickly, sort of concluding, because of the pandemic and because of, most of the shipbuilding or ship repair occurring mostly in Asia, there have been delays faced by new buildings, and the delay is anything between, roughly 4 weeks to 8 weeks. Ships, are in repair yards, getting their ballast water management systems fitted, or getting the exhaust gas cleaning devices fitted, or even repairs. And also, because, Asia, and typically China, Bangladesh, India, are key areas for recycling. And even when these ships are, the old ships are being sent for recycling, there are delays being experienced. So in terms of, the disruption, this disruption has filtered through across the yards, which are the new building yards, right into the recycling yards as well. Then looking at, the other disruptions in the supply chain, there have been port delays at various ports because of, the quarantine measures or the social distancing measures. There have been cases where the ships have arrived into port and the charterers have declared force majeure because of the port being closed, and the ships have not been able to, offload their cargo. What I would also like to mention is the crew changes. We spoke of the seafarers. So the seafarers, after doing their tenure on the ships, need to move, back home. But because of, the impact on the ports, because of the impact on airlines and some countries closing their borders, it's difficult for the crew changes as well. Ships also, mandatorily have inspections when they are in ports. All this is being impacted. Then in terms of, we spoke about the IMO 2020, whereby the sulfur tax has been brought in. So, more than 50 companies have come together to make what is called the Trident Alliance to ensure that there is, a global enforcement across, that nobody is, trying to cut corners. It's like creating a level playing field for everybody. Now, also, more than 60 leading banks who, handle loans worth almost $140 billion to the shipping industry. They've come together by putting what is called the Poseidon Principles. And the key aim for them is that the assets that they are lending credit to, they should comply with the regulations going forward. And any new asset which is being given credit, they're trying to vet that asset, for whatever the life of the asset it will comply with the regulations during that period. And that's why we are seeing quite a few ships which are having dual fuel, engines, and that's how things are evolving. Then getting to zero collision is a group of more than 90 companies which have come together to put in their best resources to look at technologies which can enable to meet the IMO decarbonization goals. And it could be looking at, batteries. It can be looking at, renewable sources like solar. So there are companies who are trying to put together all their best efforts to see that by 2030, they can start looking at bringing in ships which will aggressively meet the IMO's greenhouse gas emissions agenda. Now, given the current scenario, I think we have to look at that because of the demand collapse across commodities, there will be stimulus measures which will be needed across various economies, and that will sort of drive a little bit of demand because people will still have to, have the commodities which the daily essentials that they need, whether it's rice, wheat, etc. So, these stimulus measures in some way will help shipping in creating some demand. And lastly, as a result of the decarbonization and the current pandemic, I think we would be looking at a reconfiguration of the supply chain. And as Carl mentioned earlier, it may not happen, but people would look at, previously it used to be that, everybody went for globalization, and on the shipping industry, to get economies of scale, we started seeing, bigger and bigger ships like 20,000 plus, TEUs for container ships. But the current technology for this alternative fuels that is there will find it quite hard to sustain such big ships. So it's a nice time for, the decarbonization agenda and also the reconfiguration of the supply chain, and then look at how best that can be optimized. And I would just like to close by saying that where we are at this time, to quote Alfred Tennyson, the old order changeth, yielding place to new. And, we hope new things will evolve from this. And on that positive note, I would say thank you for listening.
Thank you so much, Captain Amrit. Always a pleasure to have you speak, and always informative, which again brings us right back full circle to what we talk about. It's all about information. It's all about data. Now, we are running close to the end of the hour here, and I know we can spare some time, but I do respect everybody who's been on the call, asking questions, listening, and interpreting everything we have to say. One of the greatest things that I've found being here at Refinitiv is that really it's not just about what we do, it's how we do it. And in these times, having a person to reach out to, having someone to talk to, and hopefully in the near term, having somebody to see and answer those questions for you is kind of where we stand out. So we're really appreciative of everybody's time and everything that you've asked. We probably will not get to every question today, or any questions for that matter at all, just to be considerate of time. We will answer your questions. We will get back to you. Please, by all means, do not stop asking questions now. Please reach out to us on LinkedIn or to email and follow up with us, and we will follow up with you. Now, we're just going to quickly run past this because we do have the questions here, but again, running out of time. Just want to kind of review some of the things that we went over here today. Using our platform icon, you can see that we cover everything from economics to shipping to commodities, but that proprietary research, the analysts that we have in-house, the people like Captain Singh who are able to talk to you, answer questions, and help you figure out how you're gonna work in that supply chain going forward. So I want to thank you all for just taking time to listen to the webinar. This completes the webinar. Again, we'll get to your questions. We'll email you back with your questions. And we said at the beginning, we will email the webinar recording later this afternoon. The slide deck will be all we send along too with all the registrants and attendees. You'll also see a survey pop up shortly. So if you would please take some time to complete the survey. It's very short, and give us your thoughts. We'd love to hear your feedback. And one more thing here, stay tuned for the third part of our next series on supply chain. Next week, it'll be next week of managing disruption at risk in the global markets from our team here at Refinitiv. With that, I want to say thank you again. Stay healthy, stay informed, and we look forward to hearing and talking to you soon. Thank you so much.
Thank you.